Hi there, I'm Lindsay Biscaya. Welcome to Market Call. Gordon Reid is on the show today. He is president and CEO at Goodreid Investment Counsel, and he'll be taking your questions on U.S. equities. Here's how you can reach us. You can call us toll-free, 1-855-326-6266, or you can send us an email to marketcall@bnnbloomberg.ca. Gordon joins us in studio. It's great to have you in.
Thanks for having me.
So let's talk about the markets as a whole, because you say the first half of this year, the markets have really taught people a lesson. Company fundamentals carry more weight than geopolitics.
Yeah.
What do you mean by that?
Well, people react to what's going on in their own environment. And when we hear daily, the stories of the turmoil in Iran, and we hear about the Fed raising rates, dropping rates, which way are they going? We think that that's really the thing that's going to affect our stocks. But in fact, over decades and decades, we've been taught that the thing that is the most impactful to stock prices are the fundamentals of the particular companies. So there's an old adage out there that says that stock prices are the slaves of earnings. And it's proven time and time again that if a company performs well, it will manage to navigate through the external noise.
You also say, too, that we're obviously seeing concentrated portfolio in hyperscalers and chip companies, and that concentration will dominate, but there is a bit of a risk to that, and we're seeing that right now.
Yeah. The risk, of course, is that we see what's winning, what's working, and over a period of time, our portfolios become concentrated in those industries and sectors. And that introduces a lot of portfolio risk that is only evident after it's too late. And we all know the lessons of diversification. It's not bad to have some sectors, some industries that may not be rewarded today, but whose companies are of great quality and will be rewarded tomorrow. And just let them stay in the sun or out of the sun in the shade, and they will appear. For example, right now, we're at a 20-year low of healthcare as a percentage of the market cap of the S&P 500. And who would have thought, years ago, if we'd said, well, in 2026, will healthcare be a dominant sector? Well, with an aging population and new technology in treatments, you would have thought that technology would be a leadership group, but in fact, it's in the shade. But it will come out of the shade and into the sun at some point.
Healthcare, you mean?
Healthcare. Sorry, did I say technology?
You said technology, but I was going to ask about healthcare. So do you feel like if people are trying to diversify away from like AI and tech stocks at the moment, are there other places that you think people should be looking into?
Yeah, healthcare is one of those areas. I think there's definitely good opportunity there. It's a very broad and vast area. You have to be careful about the sector, the industry, and the particular company that you're invested in. But if you do your research and concentrate on quality companies, they will see through.
Okay, we're going to take a quick break, but we will, of course, be back with Gordon Reid of Goodreid Investment Counsel, taking your questions on U.S. equities right after this. Stay with us. Here's how you can reach us. Welcome back to Market Call. Gordon Reid joining us in studio to answer some of your questions, and we'll start answering them now. We've got an email question, this one coming in from Faye, and it reads, I invested in Boston Scientific Corporation last year. I'm wondering if I should now exit because of its decline, or wait, or add. What is your guest's opinion? Okay, Boston Scientific Corporation, what do you think?
Yeah, that's been a tough investment over the last year. We've looked at Boston Scientific over the years. We've never made a purchase in that stock. We've done a number of deep dives. And our conclusions were that its organic growth was at some risk, especially given the very demanding multiples that were asked of the stock. So it was trading at a premium multiple because of its success. And we had to ask the question, is that success going to continue or at risk? And we felt that it was at some risk in a changing environment in medical devices. That's proven to be the case. They came out last quarter and said that their organic growth, instead of growing at the 10 to 11% that they'd previously projected, was going to be 6.5 to 8%. And of course, in a high multiple stock, what happens is the bottom just falls out. People lose faith, and that's exactly what's happened with the stock. It's more or less been halved. Going forward, there will be a time for this stock, but they're still losing share to the likes of Medtronic and J&J and even Abbott. They'll obviously work to try to stabilize that. And, you know, you have to keep an eye on these things, but I'd rather let it bottom and maybe even pay a higher price for greater certainty in a stock like this.
So for someone like Faye who already owns some of it, maybe just wait, is what you're saying?
Well, I don't know Faye's circumstances, the percentage that she owns in the portfolio, so I'm reticent to give advice on air about that. But normally with these types of situations, when something goes bad, you're better just to cut bait and move on. And you've got to think about how you can utilize the Boston Scientific dollars that you now have into the future. Are they better to stay there and wait, or are they better utilized in another more constructive situation? Often it's the latter.
Okay. We're going to go to the phone lines now. Chris is calling in from Delta, BC, with a question for Gordon. Hi, Chris. What's your question?
Oh, good morning, Lindsay, Gordon.
Hi, Chris.
Gordon, in reference, yes, to your thoughts at the beginning of the show about some sectors that are out of the sun right now and in the shade, pardon me, I've been building over the last couple of months a position in Lennar, which I know was sort of the home builder that you gravitated to for a long time, and I think you've actually since moved on. But it's really found a support level here, at least over the last few months, and hasn't really gone much lower, has had a few pops higher on the higher beta risk on days, et cetera. But my question, long story short, is I'm wondering if you are considering this name or the home builders as a group, long-term patient investor, and thank you. I'll hang up and listen.
Great, Chris. We do have some representation in the home builder group. We like the group longer term. It's had a tough period of time because of higher interest rates and also the dynamics of the industry. Just yesterday, I guess it was, the House passed a housing bill, which is going to be some support for individual home builders. They've restricted institutional money from owning individual homes for rent, which means that they're bringing out the home buyer to the new home builders. We like Lennar. We sold it, as Chris mentioned, not because we didn't like the company, but because they were doing a reorg where they were spinning off the land portion of their business. And from a tax standpoint, that can get a little bit messy, especially for Canadian taxpayers. So we exited, but we still like the group. Toll Brothers reported the other day, and it was a fairly constructive report. We also own Pulte, which reported as well, fairly constructive. So we see some bottoming in the area, as Chris does. So as an owner of Lennar, I would support him keeping it.
Okay, back to the phone lines we go. Mike is calling in from Toronto with a question. Hi, Mike. What's your question?
It's about Gildan. So I'm just wondering what your price target is, 12 months for this particular stock, because the research that I have access to, these three reports, have targets anywhere from $98 to $130, which is quite wide. And so I guess the issue with this stock is the potential for a surprise upside, revaluation, because what my research says is that, or what's missing out of the research that I have access to, is any mention of AI. So, and with this company, I'm pretty sure they're using AI to, help them with the Hanes Brands acquisition, because that was like a semi-garbage kind of operation, and to make it more efficient and improve costs, with AI, not just with that acquisition, but with our own supply chain and demand forecasting, et cetera, et cetera. So yeah, if you could let me know what your price target is and the, I guess, percentage chance that there's surprise upside to your target, that'd be great.
Okay. Thanks, Mike, for that question. All right, a lot to unpack there with Gildan. What are your thoughts, first of all, just on the company? We can get into the AI side.
Sure. We own Gildan on in our Canadian portfolio. Donnie Moss, our Canadian portfolio manager, has just recently added Gildan to the portfolio. Obviously, we like it. I'm going to disappoint Mike by telling him that we don't set price targets. Price targets are very comfortable. Investors like them because they're told what the future will bring. They're somewhat useless. You have to look at what's going to happen to the company and let the market respond to the fundamentals of the company. That's I think the right way to look at it, as opposed to set a price target and hope it gets there. So we think there is a long runway here with the Hanes acquisition. Hanes was notoriously badly run. And I think the acquisition by Gildan, which is known as a good management group, will be productive. We've gone to a couple of investor days, and they've supported that thesis. So we're quite enthusiastic about the company, and it's a piece of our Canadian portfolio.
Okay, we'll leave it there because we've got to take a quick break, but we will be back with Gordon Reid of Goodreid Investment Counsel taking your questions on U.S. equities right after this. Stay with us. Welcome back to Market Call. We are going to take more questions for Gordon. We're going to start with an email question. This is from Ashton, and this is what the email says: is Pinterest, and there's the ticker, a buy, sell, or a hold? Short and sweet. What are your thoughts on Pinterest?
Yeah, I wouldn't be a buyer at this point. I'd be a seller. The stock is down 75% over the last 5 years. It's an app that certainly is of interest to certain groups. They've got a reasonable monthly active user base, but there's obvious AI threats. How wide is the moat for that application? On the plus side, Elliott Management has invested about $1 billion through some convertibles in support of the idea, but not enough for me to make an investment.
The idea of Pinterest, you mean?
Yeah.
Too much competition maybe as well, though?
Well, there's a lot of competition in the area, and with AI, we've all read the demise of software and different applications, and I think this is certainly the risk here.
Okay, back to the phone lines we go. Amin is calling in from Ottawa with a question for Gordon. Hi there, what's your question?
Hi, good afternoon, Mirella. My question for the guest is, I'm a staunch believer of you, and I made a couple of million. Now, my question is about gold. I have AEM, I have Barrick, I have all the gold stocks, and I'm still holding on them. But they are not performing well. Should I buy more?
Okay, thank you for that question. So gold, it's gone down in price. If you have gold stocks, would you add to that?
We have some representation in gold, again, in our Canadian portfolio through Agnico Eagle. And we've recently added to that, but we're still underweight gold. Gold represents a historically high percentage of the TSX, which isn't a big surprise given that it's done so well over the last while. We, in fact, did an article that's available on our website, Goodreid.com. If you go to the Insights tab, and you'll find the article on gold written by, again, Donnie Moss, our Canadian manager. And he gives an historical perspective on gold, not just what's happened in the last year or two, but what's happened in periods where it's had a surge and become a high percentage of the total of the TSX. And it's a good historical backdrop to our current situation. So viewers are welcome to go to the website and read that.
Okay. We'll leave it there. We're going to go back to the phone lines. Mike is calling in from Windsor, Ontario with a question. Hi, Mike. What's your question?
I'd like to know your view on Google. I bought some today and for a long-term hold. Thank you.
Okay. Thank you.
Yeah, it's
Alphabet, it's been
yeah.
climbing.
Yeah.
A lot of talk of some big spending, though.
Yeah, yeah. It's if you think back, 18 months, it was in the garbage heap. Everybody thought, well, search is dead. They're going to be cannibalized, and they're going to lose share. And people who have watched me over the years have known that my position was that without question, they're going to lose market share because they had 92 or 93% of share of search. But, and people will remember this, I've talked about it as a bigger pie story, that they will lose a share, but it'll be a much bigger pie. So their total benefit is going to be much greater. And that's exactly what's happened. And they've folded AI into that search model. Again, 18 months ago, people were saying that other large language models would dominate and Google would be left behind. Lo and behold, here we are, and Gemini is in a leadership position. Doesn't mean that they're going to stay in that leadership position, but they're certainly there now, and it's benefited holders of Google. Alphabet was up 66% last year. So for a huge mega cap company, that's pretty spectacular. Yet it does not have a really demanding multiple, even at this point. It trades in probably the high 20s in terms of price to earnings multiple. And is spinning off a tremendous amount of cash. It also has some buffers. You think of Alphabet and search, that's great, but you can also think of it as Alphabet and YouTube, the largest streaming network in the world, double the size of Netflix in terms of market share. And you can go further into Waymo, one of the leading autonomous driving vehicle companies. So lots of opportunity in Google. So I would certainly support Mike in his investment in Google.
Okay. We've got an email question, this one coming in from Jean, and it reads, would you buy Costco or Walmart for a long-term hold? Is there one that you like better than the other? Or thoughts on the sector as a whole?
I'm going to pass on both. Both great companies, but both very expensive companies. Costco, I think, is trading over 50 times earnings, and Walmart, I think, in the 40s. For companies that really are reliant on the consumer, that have a model that is really fairly low margin model, these are really high multiples. So I would pass. We saw earnings out of Walmart this morning.
Yeah.
The earnings were okay. I think their projections, their look at future quarters was, a little tough.
And also with retail in general, right? Like the higher fuel costs are starting to weigh on these companies. There's worries about a weaker consumer. I don't know if that concerns you.
Well, it does. In that regard, Walmart has usually done better in that environment because from a demographic standpoint, it attracts the lower income group, unlike Costco, which is a little more premium. But everybody's affected by a consumer that is on its back, and there will inevitably have, or high fuel prices will inevitably have an effect, and Walmart this morning called that out.
For sure. Okay, we're going to take a quick break once again. When we return, though, we'll look at some of Gordon's past picks. That's next. Stay with us. Hi there, welcome back to Market Call. We're going to go through some of Gordon Reid's past picks now. So these are from May 13th, 2025, so just about a year ago. Your first one is Elevance Health. When you recommended it, it was at $375.40. Now it's at $392.07, total return of 6%.
Yeah.
It's pretty well. You still holding this one?
We are. It's been a very tough group, medical insurance or health insurance. The whole group has been hurt. The sort of leadership company there is United Health. We think that Elevance on a peer group comparison is of a better value. It trades a number of multiple points more cheaply. Doesn't have the risk profile that United Health has, but every one of them has been affected by medical cost ratios rising. They've gone from the mid 80s up north of 90%. For a variety of reasons, some of which date back to COVID when people were really reticent to have any medical procedures done. So these companies really did quite well, and reimbursement rates dropped because of it, because they were doing so well. And then bang, there was this tidal wave, tsunami almost, of people coming back for the same reasons. The skies had cleared and they were now going to get procedures done. So it's been a very turbulent period. We think it's bottoming. We're seeing that in some of the narratives out of these companies, and they're going to settle into a reasonably profitable situation, which will allow stock prices to rise because they're trading right now at historically low valuations. So we're going to be patient on this one, but it's been a tough slog.
Next up is Leonardo DRS. So recommended at $40.64, now at $43.71, a total return of 9%. Maybe for people also that missed your picks last time, what is this company? What does it do? And then are you still holding it?
We are still holding it. It's a defense contractor. DRS was a U.S.-based defense contractor, and it was purchased by Leonardo, which is an Italian defense contractor, to form Leonardo DRS. And then they tacked on an Israeli company called RADA, which is in the radar, tactical radar situation. The whole company is now a provider of defense products to a lot of different countries, but they're eligible to provide to the U.S. because of the DRS connection. They do propulsion systems for submarines. There's a new class of submarine that's being introduced called the Columbia class, and they do high-tech, AI-empowered propulsion systems. We all know that geopolitically things are very unstable, and we're seeing defense budgets rise around the world. The U.S. defense budget has risen certainly north of 10% in the mid-teens. And there's talk of a $1.5 trillion defense budget in the U.S., which will obviously give a lot of opportunity to these types of companies. In addition, we've read about what's happening within NATO and the pressure that they've had to raise the percentage of GDP that they allocate to their military budgets. So just a good area to be in, and Leonardo is a great company.
And something you're going to hold moving forward. You said you still hold it, right? Okay. Last past pick is JP Morgan. So recommended at $263, now at $302, return of 15%, total return of 17%.
Yeah.
Pretty well.
Yeah, the whole banking group is in a great position. I think there's been a bit of a delay in terms of reward. Going back a year, I think most people would have thought, because of deregulation, because of what we thought was going to happen to interest rates going lower, that it would be a very, very encouraging for these types of companies. It has been modestly good, but the table's still set. So there's still capital markets business to be done. We've read about SpaceX coming. It's going to be north of probably $2 trillion. And we're also seeing OpenAI and Anthropic, perhaps north of $1 trillion each. So there's tons of capital markets business, to say nothing of the crumbs of hundreds of billions of dollars, believe it or not, I'm saying that. But there's just a lot of opportunity out there in capital markets. JP Morgan's also very, very involved with borrowing and lending. Of course, they're a traditional bank, and the yield curve is steepening. So even though we've gone from what was an expectation of lower rates to higher rates, the yield curve steepening really is the money-making part of lending and borrowing and lending, and they're well positioned there. Finally, they're very good on the trading desk. So if you look at their trading numbers over the last number of quarters, they've been very strong. So there's a lot of different things happening, to say nothing of deregulation. So there's a lot of things that are tailwinds.
A lot of factors at play. Okay, we're going to take another quick break. We'll be back, though, with Gordon Reid of Goodreid Investment Counsel, taking your questions on U.S. equities right after this. Welcome back to Market Call. We're going to answer, well, Gordon's going to answer more of your questions for you. We'll go right to the phone lines. Anne's calling in from Thornbury, Ontario, with a question for Gordon. Hi, Anne. What's your question?
My question is on Micron. Could he please explain what they actually do, and would it be a good time to buy now?
Yeah.
Okay, always good to go back to the basics. So what do they do, first of all?
Well, they're a technology company in the chip and memory business, so they provide components to our computing world, and mostly on the memory side. And memory has been in very short supply. Micron is basically sold out. They've done extremely well. They're making tons of money, but they're a cyclical. And what tends to happen with cyclicals is as they peak, you get supply constrained, and they tend to roll over. You get a demand situation where they just produce and produce and produce, and then you roll over and you get an inventory glut, if you will, in the channel, and that produces the cyclicality of the company because they trough.
Are we at that point yet?
No,
Micron?
absolutely not. No, and that's the thing. It's these situations, and I would expand the discussion to include virtually all chip companies and AI companies. These situations look like they're going to go on forever. They always do. That's what's needed to force investors into the positions that they find themselves. They'll buy at any cost. So it's not over, but I'd be somewhat cautious. It's okay if it's a part of your portfolio. Make sure it's a measured part. Choose your companies carefully. Micron's a good company, but it's probably skewed a little bit towards the risk side. I prefer companies that perhaps are a little more broadly diversified. For example, we own NVIDIA, which reported last night. We owned Qualcomm. We've had to be very, very patient on Qualcomm, and only in the last number of weeks have they started to be recognized as a real participant in the AI story, and not the building story of perhaps an NVIDIA, but in the inference story. So not in the training story, but in the actual agentic using AI. And it's working out fairly well for us. So, be measured, be disciplined, but it's still a good area, but pick wisely.
Okay, back to the phone lines. Bob's calling in from Toronto with a question. Hi there. What's your question?
Yeah, hi, Lindsay. Hi, Gordon. Gordon, I'm wondering what your thoughts are on Microsoft. It hasn't been doing very much over the past number of months, and I'm wondering if you would consider it a strong buy at this price. Thanks a lot for your anticipated comments.
Thank you.
Yeah, thanks, Bob. We do own Microsoft in our U.S. large cap portfolio. I agree with you. It hasn't done much over the last while. It had a bit of a pop after the first quarter. But I think the fact that they were affiliated early with OpenAI has hurt them. And the fact that they've now extricated themselves through a rewritten contract, a revised contract and agreement with OpenAI is some encouragement. There was a report just this morning that they were in talks with Anthropic to do some work with them. And that's going to be encouraging to people who are looking at Microsoft as an investment. The interesting thing about Microsoft is that their software base really isn't in jeopardy. Like, nobody's talking about the demise of Windows.
Right.
AI, if anything, is going to be a great tack on to a Windows complex, and they've got Copilot. Well, Copilot has been sort of tepid in its take-up, but just as I was talking about earlier with Alphabet and Gemini, these things can turn fairly quickly. Microsoft at these prices with what they're doing fundamentally is quite inexpensive. It's trading probably in the mid-20s in terms of multiple, lower than their historical multiple, and they've got tons of cash flow coming. So they're investing a lot of it, but there's I think, good things to come from Microsoft.
Okay, we've got an email question from Sabrina. So this reads, Capital One Financial. There's the ticker symbol. Your guest thoughts on Capital One Financial? Yeah,
I wouldn't invest in Capital One. Their return on equity, return on assets is historically very low, and it's falling. They made quite a large acquisition about a year ago, $35 billion acquisition of Discovery, which I gave a little bit of a boost to the short-term numbers, but longer term, I think it's just going to be sort of moved into a operating model that has insufficient profitability metrics. So I would pass on Capital One.
Okay, we're going to take another quick break. We will be back, though, with Gordon Reid of Goodreid Investment Counsel, taking more of your questions on U.S. equities right after this. Welcome back to Market Call. We've got Gordon Reid in studio taking your questions on U.S. equities, and we'll go right to the phone lines now. John calling in from Oshawa, Ontario, with a question. Hi there. What's your question?
Thank you, Lindsay. Gordon, my question is on a two-part question, not immediately related to Tesla. Recent revival in the stock price of Tesla. Are you bullish on this? Do you folks own Tesla? And just a side question, is any guesstimate on IPO for SpaceX? Mm-hmm. Thank you so very much.
Thank you. A very good question. I think everyone's watching for that IPO bit of news. First of all, are you bullish on Tesla?
No. We own GM in our large cap portfolio, which has done extremely well for us. Tesla is just a little bit too much on the cowboy side, the wild side. Not really sure what drives it. Anybody who has bought it as a car company, I think, has been confounded by the fact that it is done okay, but it does not support the wild valuations. And the reason it doesn't, or the reason it has those wild valuations, is that Tesla is seen in many quarters as much more than a car company. Yeah. It's seen as a technology company, robotics, and we heard John reference SpaceX. There's a lot of talk out there that Musk is looking to combine Tesla with SpaceX at some point. So it attracts that type of investment dollar. We don't have any privileged information on the SpaceX IPO. We hear, like everybody else, that it could be north of $2 trillion, which is unbelievable.
So that probably doesn't interest you either, then?
No. Yes. No. I don't even remember, Lindsay, the last time we bought an IPO. Right. IPOs are a strange or animal. They're really presented as something to buy because it's got the glitter, yet you have to look at why it's for sale. Why are companies coming to the market? Well, it's because the seller thinks that it's a good time to get a premium price. Do I really want to be on that side of those trades? So let an IPO happen, let it settle, let it prove itself as a good quality fundamental company, and then see whether you want to make an investment. We speaking of Musk, we did an article that's on Goodreid.com, again under that insights section, on companies that have founders as their leadership group. And we've done some statistical analysis on how they've done compared to other companies. And it's kind of an interesting read. Again, Donnie Moss wrote this, and I thought it was a great read. It's been posted for a few weeks now. And really the question is, who runs the company and why do they care? They're obviously super wealthy. What motivates them? Right. How do they drive a company versus, a career business person managing a company.
Because that can tell you a lot about the long-term trajectory of the company.
Yeah,
right?
yeah. So it doesn't necessarily all end well, but there's a lot of interesting aspects to it. So it's a good read again on Goodreid.com under Insights and articles.
All right, we're going to go back to, actually, we're going to go to an email question. This is coming in from Hal, and it says, would today be a good day to buy Deere, or are there future losses in sight for the company? Deere reporting today, of course.
Yes. Yeah. I'd be really hesitant on Deere. You can see that off of the January low, it had a spurt, but we've looked at Deere. We've owned it in the past, but many years ago. It's highly cyclical. It's tied to the fortunes of the farmer, to ag prices. So you have to get the commodity pricing correct. You have to get the spend correct. You have to get the economic situation of the farmer correct. So it's a very tough cyclical to get in and out of, and you've got to be very adept. So I wouldn't be a participant at this point. And if you are, good luck. Yeah.
Risky at the moment, like as you say, they're tied to so many different things. When you look at the weather and the droughts that we've been having in southern U.S., that's one factor. The war, obviously, in the Middle East and the price of fertilizer, that's another factor. Tariffs as well. And there's a couple of things in their latest quarter that were offsetting some of that, but maybe not enough, right?
Yeah. And then fuel prices, which is obviously a big input cost to the farmer, So, there's a lot of moving parts.
Stay away from that sector maybe for right now. Okay, we're going to take a quick break once again. When we return, we'll take a look at some of Gordon's new top picks. Stay with us. Join us tomorrow on Market Call. Martin Cobb will be on the show. He's Senior Vice President of Equities at Lawrence Steinberg Wealth Management, and he'll be taking your questions on global and North American equities. And if you miss Market Call, you can always check out our podcast. You can find it on iHeartRadio and other platforms. And you can also watch full episodes on our YouTube channel. And time now for some of Gordon's top picks. So we're going to go through these one by one, obviously. The first one is Apple. Big company, out of the big seven, I guess. This is the one that you like the most?
No, I wouldn't say I like it the most.
Okay.
We own a number of companies in the Mag 7.
Right, you did mention that. So this is just your latest pick.
Yeah. I rotate them in terms of top picks. We've owned Apple for a very long time. We first bought it in 2006. I think we paid the equivalent of $2 a share at the time, and it's split many times since then. But just in the last few weeks, I've added to Apple. We've trimmed it many times over the years because we don't want it to dominate the portfolio in terms of percentages, because that's a risk management tool. But we've added to it most recently just to bring it back to a market weight, because we think there's really good opportunity on the AI front with Apple. You don't hear a lot about AI in Apple, and people have said, well, they've missed the boat. I think you just have to look at Apple's history to understand that probably they haven't. They usually let other companies do the hard lifting, and then they step in once things are a little bit more mature, and a decade later, they own the sector and the category. And you think back to different devices that we now rely on every day, they weren't the initial adopters and inventors. So I think Apple will be there. There's talk of an AI phone. We're seeing changes in management. John Turnus is now the CEO of Apple. Interestingly, he comes from a hardware background. Hardware engineering was the group that he ran. I think that's maybe an interesting tell. And we should stay tuned for that. But they've got tremendous resources. They produce an unbelievable amount of cash. They're not a company that is known to make big acquisitions, but they certainly will employ their cash in a productive way. They own the App Store. They own the consumer from a technology standpoint. And I think 5 years from now, the AI aspect of Apple's involvement will be a lot clearer.
Because I remember it wasn't too long ago also, though, that Apple was warning that, smartphones are going to be more expensive moving forward. Mm-hmm. Is that maybe just a small headwind for you for that company? Nothing big compared to what maybe the plans are for AI in the future instead? People maybe not buying as many phones as often?
Yeah. I think a phone is a must-have.
Yeah.
We were talking in the break about how I commute to work, and I commute in public transportation, and you just have to watch what people are doing, and it's almost you just don't see people there without their phones out. Everyone has their phone out, and many people have two, so you can see them switching back and forth. But in terms of the must-have aspect of it, they've got to make it much more enticing to pay a higher price. And whether it's 5G or whether it's an AI-empowered phone, whether it is linked to the glasses we're wearing, and maybe they do a deal with Meta, who knows? There will be an aspect to it that will lead us as individuals to say, well, of course I have a new phone. Yeah. I have to.
Fair. Okay, next one. I asked you how to pronounce this earlier, and I already forget. Celanese?
Yes, Celanese is a chemical company, and they do polymers and different types of chemicals, acetyl chemicals that are really part of our everyday life, whether it's in our food products, fabrics, pharmaceuticals. Mm-hmm. You see acetyls utilized because chemicals are a big part of manufacturing now. So Celanese has had a tough time. They are a cyclical. The pricing background has been weak, but that's what happens with cyclicals. I talked about it a little earlier with respect to the technology area and chips. It happens in other areas as well, including chemicals. We're starting to see a bottoming now. Pricing power is coming back to the chemical area, and this is a company that not that long ago, say 4 or 5 years ago, made $18 a share. Yeah. And it's trading in the 50s. So there's a big opportunity if you get the timing right on cyclicals.
Got about 90 seconds left, so I do want to get to Visa. Tell me about your last top pick.
Yeah, well, Visa is very well known. It's ubiquitous. We're using plastic more and more. Mm-hmm. I don't use cash very much at all. You take your card out and swipe it. So it's all about transactions, and the numbers are very encouraging for Visa. They continually increase the number of transactions done. They're the beneficiaries of modest inflation. I say modest inflation because, of course, hyperinflation would be a detriment because you'd see less spending. Yeah. But a modest inflation is really a tailwind for a company like Visa because it increases the dollar spend, and that's how they get paid. They're trading at a very attractive multiple right now. Normally, their historical multiple has been around 30 times earnings, trading at around 24 times earnings now. So we think there's good opportunity there.
Okay, Gordon, we're out of time. Appreciate you coming in today. Thanks so much for joining us.
Thanks, Lizzie.
And thank you for watching Market Call. We will see you next time.